So, um, have you ever found yourself just like scrolling through investment forums or maybe articles, and you're just hit with this wall of jargon, all
Yeah.
these abbreviations?
Yeah.
It leaves you feeling, well, more confused than informed, right?
Oh, definitely. We've all been there, staring at acronyms, feeling like you need some kind of secret decoder ring.
Exactly.
Hmm.
Well, consider us your guides today. We're doing a deep dive into one of the most respected investment strategies out there, value investing. We're at six, as it's often called. We pulled together insights from, some of the giants in finance, plus the essential terms you really need to navigate the market properly, not just tread water.
Yeah. And our goal today is really to cut through all that noise. We want to give you clear, actionable insights on approaching investing with, well, patience and wisdom. We're using a whole stack of different sources, making sure you get the knowledge quickly, but also thoroughly, hopefully giving you a few of those aha moments where it all just clicks.
Okay, great. So let's start right at the basics. What exactly is Z? Because like I said, when people first hear that, they might think it's some kind of financial metric or, I don't know, a stock symbol.
Right. That's a really common misconception.
Mm.
Z isn't a number at all. Value investing, it's fundamentally a strategy. Investors look for securities, stocks, that have more inherent value than their current market price suggests.
Okay.
The core idea is finding these undervalued stocks, and you do that by analyzing company-specific data, financial data, using both qualitative and quantitative information.
So numbers and judgment.
Exactly.
Yeah.
The ultimate goal is pretty simple in theory. Buy low, sell high. The belief is that if you hold it long term, the stock price will eventually catch up to its true value, giving you a better return.
And of course, when you talk value investing, one name just pops into everyone's head, even if they're not deep into finance.
No.
Warren Buffett.
Absolutely. He built his incredible wealth pretty much entirely on this philosophy. He's the poster child for it.
Okay, so here's where it gets really interesting for me. Beyond just the numbers and the analysis, what kind of mindset does it take to actually be a successful value investor? Because it sounds like it requires a certain temperament, maybe.
It absolutely does. That's a huge part of it. Benjamin Graham, who's often called the father of value investing,
Right.
he said something really wise. Success in investing doesn't demand an Einstein-level IQ. What you really need is a superb strategy and strong emotional control. You have to be unfazed by the market's mood swings.
Unfazed.
Now-
Easier said than done sometimes.
Oh, for sure. Discipline and courage are just paramount. You have to avoid getting swayed by what everyone else is doing, or by fear and greed and making decisions without that solid fundamental analysis backing you up.
But that sounds incredibly tough,
Yeah.
especially when you see markets panicking or getting overly excited. Do the sources give any, practical tips for building that emotional muscle beyond just knowing you need it?
That's a really good question. It gets to the heart of why, frankly, so few investors really nail it long term.
Yeah.
There's no magic bullet, of course, but the sources really stress preparation and having that long-term view. If you've done your homework, you're a fundamental analysis before the market goes crazy, it helps you trust your own judgment. And tied into that is patience. It's absolutely key. Buffett himself pointed out that lack of patience is one of the factors distinguishing successful people from unsuccessful ones.
Wow.
It's about learning to just stay still sometimes, focus on the long game.
They still.
Yeah, Charlie Munger, another legend, famously said the real money isn't in the buying or the selling, but in the waiting. Being okay doing nothing if the right opportunity isn't there.
That makes me think about the whole contrarian approach, the idea that smart investors sell when others are optimistic and buy when others are pessimistic.
Right.
Ray Dalio said, when the market falls sharply, this may be an opportunity. And Graham talked about buying during bloodbath periods, going against the herd. But doesn't that also feel risky? Like you might be trying to catch a falling knife. How do you know if something's just cheap versus genuinely undervalued, but maybe still has further to drop?
That's the critical distinction, isn't it? And that falling knife risk is precisely why the fundamental analysis and understanding intrinsic value are so vital. It's not about buying any stock that's dropped in price.
Yeah.
It's about buying a quality business that happens to be temporarily on sale, basically, undervalued. The sources really hammer this home.
Yeah.
You're owning a business, not speculating. You're not trying to guess the exact bottom.
Okay.
You're trying to buy a piece of a solid company at a price significantly below what you calculate its true worth to be. Market extremes, they're temporary. History shows again and again the stock market is the best tool for money to work over the long run.
So trust the long-term trend.
Yeah, Buffett echoes this. Life and investing are long journeys, so don't worry about short-term disturbances, but stick to your long-term plan. Temporary price drops don't change a good company's ability to earn money over time.
All right, so we've talked mindset. Let's get into the nitty-gritty. How do you actually do this? What are the tools, the frameworks value investors use to find these hidden gems?
Okay, yeah, the practical side. The main tool is fundamental analysis. This is basically the process of digging into a company's financial statements, really analyzing its core health.
So reading the reports.
Exactly. You're looking at things like income, profit, cash flow, the balance sheet, and key financial ratios. Things like ROE return on equity and ROA return on assets. And to give a couple of specific examples you'll see mentioned a lot, EPS, or earnings per share.
Okay, EPS.
That's simply the company's profit divided by the total number of shares out there. It gives you a sense of how much profit backs up each share. And then there's dividend yield. That's the annual return you get from dividends or interest, shown as a percentage of your investment price. It tells you how much cash the investment is actually throwing off.
And those ratios you mentioned before, ROE and ROA, what do they actually tell us? Why look at those?
Good question. So ROE, return on equity, it measures how much profit a company generates for every dollar shareholders have invested. It's a key sign of how well they're using shareholder money to make more money.
Efficiency, basically.
Right. And ROA, return on assets, is a bit broader. It shows how effectively the company uses all its assets, loans, buildings, everything, not just shareholder equity, to generate earnings. These give you a much deeper picture of financial health than just looking at the profit number. It's about operational effectiveness. Okay, next up, a really crucial concept from Benjamin Graham, margin of safety, or MOS.
Margin of safety. Okay.
Think of it like your safety net, your cushion. It's defined as the discount price at which an investor buys a stock compared to its estimated fundamental value.
So buying below what you think it's actually worth.
Precisely. Like, if you estimate a stock's true intrinsic value is, say, $100 a share, but you manage to buy it when the market price is only $70, you've got a $30 or 30% margin of safety.
That makes intuitive sense. It's like building in resilience, always aiming for a discount. So once you've found that potential discount, how do you make sure the business itself is solid, that it can last? That's where economic moats come in, right?
Exactly right. And on the MOS, while a bigger margin is safer, it might also mean fewer stocks meet your criteria. So you might adjust it, maybe based on your timeline. Like, if you're investing for 5+ years out, you might want a bigger MOS, maybe 50% or more.
Interesting.
And maybe counterintuitively, market sentiment can play a role. If the market's really strong, maybe you accept a slightly smaller MOS. If it's weak and uncertain, you might demand a larger one for that extra safety. But yes, then you look at the economic moat. This term was really popularized by Buffett.
Like a castle moat.
Exactly like that. It's the protective barrier around a business that keeps competitors at bay. It's what gives a company a sustainable competitive advantage. It's easy to mistake a hot product for a moat, but a real moat isn't just about being popular now. It's about something fundamental that makes the business hard to attack long term.
Okay, so what are some examples of these moats?
Well, there are a few main types. First, a cost advantage. This means being able to produce things or offer services cheaper than competitors. Maybe they have better supplier deals, or they're vertically integrated, or just more efficient.
Lower costs, bigger profits.
Right. Second, a size advantage. Sometimes just being bigger helps through economies of scale. Think about advertising. A large chain can spread ad costs over many stores, making it cheaper per store than a small competitor.
Makes sense.
Third, intangible advantages. These are things like patents, strong brand loyalty. Think about Louis Vuitton. People pay a premium for the brand itself, right? That's a moat. Or maybe exceptional management with a fantastic track record.
So brand power, patents.
Yeah.
What else?
The last big one is high switching costs. This is when it's really difficult or expensive for customers to switch to a competitor.
Like being logged in.
Sort of. Think about the network effect with social media like Facebook or Line. Everyone you know is there, so leaving is hard even if you wanted to.
Yeah, true.
Or think about Microsoft Office and businesses. It's so embedded in how people work. Switching to something else involves retraining, compatibility issues. It's a real pain. That's a high switching cost.
Okay, wow. So we have the mindset, patience, discipline, contrarian thinking. And the tools, fundamental analysis, margin of safety, economic moats. But how do you actually put it all together? What are the strategies for picking stocks day to day? And maybe more importantly, what are the big mistakes people make, the pitfalls you should watch out for?
Great question. Moving from theory to practice. The sources highlight a few key areas here. First, in terms of actually analyzing potential investments, there are two main approaches people use. The first is called top-down analysis.
Top-down.
Yeah, you start broad, look at the overall economy. Is it growing, shrinking? What are the big trends? Then you narrow down to industries that look attractive within that economy. And then you pick specific stocks within those promising industries.
Can you give an example?
Sure. Like during the pandemic, a top-down view might say, okay, the overall economy is shaky, but healthcare and tech are booming while travel is collapsing. So you'd focus your search on strong companies within healthcare or tech.
Got it. Big picture first.
Right. The second approach is the opposite. Bottom-up analysis.
Okay.
Here, you start super specific. You analyze an individual company, its performance, its dividends, its management, its moat. Then you look outwards. How is its industry doing? And finally, you consider the overall economy.
So company first, then industry, then economy.
Exactly. Maybe you find a fantastic IT company through your screening, then you check if the IT sector overall has tailwinds, and lastly, see if the general economic climate supports growth.
Okay, two different ways to approach the search. What about those pitfalls you mentioned? The common mistakes.
Ah, yes, the cautions. The sources are pretty clear on several critical points. We can probably group them into a few themes. First, going back to patience and discipline. You have to remember value investing takes time. It is not about quick flips or overnight riches.
Right, the long game.
Absolutely. And that ties into discipline. Don't just react to news headlines or rumors. Base decisions on your fundamental analysis, on the facts. Stick to your plan, even when the market gets noisy or scary.
That emotional control again. Okay, so patience and discipline. What's next?
Second theme, thorough company understanding and risk mitigation. This is crucial. Don't just buy a stock because the price looks low.
Cheap isn't always good value.
Precisely. There might be hidden problems, or the company might just be, well, bad and losing money. You absolutely must understand the financials before you invest. Avoid companies consistently losing money. Also, be wary of illiquid stocks, ones that don't trade much. They can be really hard to sell when you want to.
Practical point.
And here's one often overlooked. Really evaluate the management team. Do they have a clear vision? Do they practice good governance? A great team can make a huge difference, even if it's hard to put a number on it.
The people factor.
Definitely. And finally, under this theme, always diversify. Don't put all your eggs in one basket, no matter how amazing one stock looks. Diversification is your ultimate safety belt.
Makes sense. Spread the risk. What else?
The third theme is really about continuous monitoring and adaptability. You can't just buy and forget, even with a long-term view. You need to keep an eye on industry trends. Avoid industries that are clearly in long-term decline, even if a company within it looks cheap for a moment.
So context matters.
Hugely. And even for stocks you hold, you need to regularly track their performance. Is the company still executing? Has something fundamental changed about its business or its moat? Be willing to adjust your strategy if the situation genuinely changes.
So it's active patience, not passive neglect.
That's a great way to put it. Value investing isn't set it and forget it. It's about staying deeply informed and reacting thoughtfully to significant shifts, not just day-to-day noise. And underpinning all of this is the need for strong discipline and a commitment to keep learning. The market changes, industries change. You have to stay sharp.
Okay. That's a lot to absorb, but it paints a really clear picture. So boiling it down, what does this all really mean for you, the listener? Value investing, it's clearly not about chasing trends or trying to get rich quick.
Not at all.
It seems to be about patience, really digging into the research and having that disciplined mindset focused on long-term wealth creation, seeing opportunity when others are panicking.
That's the essence of it. Remember what the legends Buffett, Dalio, Graham teach us, those market downturns, the scary periods. They aren't just times for fear. They can be massive opportunities to buy quality businesses, quality assets at really attractive prices. And maybe a final thought to leave you with, consider how these timeless principles apply beyond just investing. Think about setting any long-term goal in your life. What's the margin of safety you build into your own plans? How do you prepare to weather the unexpected challenges that inevitably come up?